SD Bullion is proud to announce the pre-sale of the 7th round in the Silver Bullet Silver Shield coin series, Cannabis. Available in a BU satin finish and also a proof-like mirrored finish, SD Bullion is an authorized dealer of all Silver Bullet Silver Shield rounds. Purchase your SBSS series coins from the dock today at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, for all our listeners who tuned in last week, we closed the show last Friday by advising listeners to look for a big rally in the metals this week. Eric and I both pointed out that gold and silver had been capped by the cartel last Friday at, I believe it was 1950 repeatedly. It had broken out in the access market through that cap and to look for a big move to come, possibly to as much as 2250. Here this week, and we sure saw that, Eric. We had a week for the ages this week in both gold and silver. We haven't seen a rally like that in a long time, since 2011 at least. But we had silver up almost $4 on the week, almost touched $23.50 today before closing the access market at $23.25. And gold as well is up another $20 today. It's been about 3 days in a row. It's been up $20. It touched $13.80 earlier in the COMEX session and closed almost at the highs for the day and the week at $13.77 today, Eric. Quite a week, to say the least, for both gold and silver.
Indeed, and what we saw last week, which enabled us to make that call, was the pattern that on Thursday and Friday you had capping in the early hours, but then again, primarily driven by people wanting to cover their shorts, the precious metals moving higher and showing very strong closes, closing on Friday in a fashion that was pretty clear, particularly in silver, where the people who were short looking around and saying, gee, this market's beginning to change in terms of its character and is moving much, much higher. We want to cover our shorts going into the coming week, and that's exactly what we saw. And the momentum that we've had is very profound in terms of the switch. I mean, if you look at even things that people pay attention to from a technical analyst point of view as far as relative strength, we've shot up from about 40 or so on the IRSI index to 77.2 as it close on an end-of-day basis today in silver, which is a really, really big shift in just the 5 trading days. It, in fact, has happened, the price's appreciation, I should say, have happened a bit faster than even I had expected. I spoke of 23 and change as a period where we'd probably a level at which we'd see people pulling back and having a rest in terms of short covering and a burst of momentum. But I expected that to be sometime next week as opposed to getting here Friday with that already happening. And once again, on Friday, we have silver and gold, and in particular gold now leading silver or keeping pace with it, showing signs that the short covering panic is going to continue next week.
We certainly don't have any signs that silver is ready to take a rest. I think it had a brief pause on Tuesday, a slight correction after the big spike on Monday, but right. Wednesday, Thursday, Friday, it's been up.
And on each of those days as well, we've had some corrective impulses. Early in the morning hours, both silver and gold were under some pressure, both Thursday and Friday, but they closed up again on the end-of-day basis in the North American market because there's just way too many people out here who are short looking to cover themselves because they know they're stuck. And that's a very powerful tinderbox to be dealing with. And then when you combine that with what's going on in the bond market backing up, and when we had the 10-year note at this point closing on a basis of 2.84%, which is the highest close that we've seen in years. I would hate to be Ben Bernanke this weekend because even though he's not going to be making many public appearances going forward, and he's said sayonara to Jackson Hole, the annual powwow where central bankers are obligated to go if they're going to be taken seriously. All of the signs are that the financial market is coming under extreme strain, no matter where you look. I mean, the dollar is beginning to roll over, the bond market's backing up. You have been saying from many, many months, going all the way back to March, that we need to be paying a lot of attention to the fiscal mess in Washington and the whole discussions of debt ceiling and the funding that is going to come in September and October, and ironically enough, the bond market's rollover and timing of such is matching
It's all coming together.
And it's dangerous. And people are beginning to pull out of financial assets in the United States. The real estate market is probably going to roll over. The general equities market, as defined by the Standard & Poor's 500 index, is already rolling over. Leading stocks that were the drivers of the last move, as Google would be a good example, that's already started to roll over. I mean, it only made a high in mid-July of nearly 930 or so, and now it's beginning to deflate. So
Right.
It's a very dangerous environment.
Getting back to the bonds a little bit, you touched on the fact that the 10-year closed a 2 or 3 year high today at 2.84, and that's on the verge of rolling over, and
it's in the process of rolling over.
Could easily see 3% next week. The 30-year already has rolling over. So really throw that on top of, there's a statistic that came out this week that was very interesting, that the U.S. ratio of mortgages, or basically housing sales, I believe it was like 60 to, it was in the low 60% right now, are cash only, full cash sales, so not traditional mortgage or leveraged real estate purchase at all. So add into that rates jumping here if we see the 10-year spike above 3%, and we're going to be seeing a cash market in real estate, which effectively prices out the majority of the middle class America, at least until real estate prices correct substantially to reach what they can afford on a cash basis, which is, for most of middle class America right now, their savings are practically non-existent.
Exactly, and moving in the direction of breaking that down in terms of basic economics and what it means for our society. It's a very good point. It speaks to the fact that the investors that have been pushing up the housing market in the last year and a half in a so-called recovery bounce have largely been the wealthy. It has been, as well, institutional investors in form of BlackRock and J.P. Morgan and all these other hedge fund establishments that have come together to pool money to go out and buy rental real estate in particular, but commercial real estate as well, and even a lesser extent foreclosures and so forth in the residential market. Those guys are selling now, on balance, with the exception of BlackRock, for whatever reason. I'm not quite sure where their house is seeing things, pardon the pun, but when you have an economy that's based 70% on consumption in the United States and no income growth whatsoever, and the lying that's going on when it comes to our employment statistics, it also supports this general thesis that the illusion the powers that be have been trying to maintain over the last few months about an economic recovery is beginning to unravel. And that's what the bond market in particular is telling us, folks. The bond market is an order of magnitude larger than the equities market. And it's so large, in fact, that the Federal Reserve and other central banks cannot manipulate it in the long term. They can only achieve directional force on the long-term rates when the hedge funds and institutional players and sovereign wealth funds and government interests in the form of China and Russia and other very large players all agree to play along with the shell game and charade of a period of time where interest rates are going to go down. And then everybody believes that that's the trade to do because, quote-unquote, the Fed has your back. And then maybe you put a cherry on the top of that sundae in the form of people being afraid of an asset-based crash that would form a deflation wave along the lines of 2009, such that they, okay, people say, if that were to happen, then bonds would be the place to be for protection in the short term. Add all that up, and that's the thesis that we've been running with and what's been governing the financial markets for the last better part of the whole year or so, and it's changing. That's the take-home point message, is that all of these dynamics are beginning to change, and you can see that most clearly in the bond market, and that's why we were underscoring that as early as last May, that something had changed in the bond market, and we needed to pay attention to what that signal value was. Now that we're here in mid-August, we can see what, in fact, it actually is translating into, and it's people leaving the financial markets. And in September, October, the traditional period where there's a lot of volatility, is looking to be pretty scary, particularly when you layer on top of that the political dynamics and shenanigans that will be going on at that time. people are embracing the precious metals market again, which is rather refreshing.
Yeah, it is rather refreshing to see the stock market rolling over, the bond market rolling over, and gold and silver spiking, and silver up nearly $4 on a week. It's been a while since we've seen all those circumstances. Getting back to the metals a little bit here, one other statistic here that's pretty interesting. It's been well documented that the GOFO rates have been negative for nearly a month. I think it is now 30 days as of today. They had been easing up a little bit, but today the 6-month turned back negative again, 0.005 negative. And what's really interesting and almost amazing is we're up almost $200 off the lows now, and we're still having backwardation throughout the 6-month GOFO rate, not just the 1 month or the 2 month or the 3 month. So the shortage of physical really isn't lessening as you would expect with a $200 price move in the price of the paper markets, the metal. It's pretty interesting, don't you think, Eric?
Absolutely. I mean, higher prices would theoretically liberate a little more supply in the marketplace such that GOFO would presumably be declining. But 30 days of GOFO negative rates is something that's never been seen in the entire history of that statistic.
Right, and we have a $200 move to the upside in gold, which you would think would significantly ease the physical tightness, but just the opposite. We have, after three or 4 days in a row that the 6-month had turned back positive, today on Friday that turned right back around, and we had worsening on pretty much all the numbers, the 1 month, 2 month, 3 month, and 6 months, and even the 12 month, which is still positive, tightened up a little more, but just increasing physical tightness in the midst of strong moves to the upside in the price.
Exactly. And there really hasn't been a large shift in terms of the return of buying in North America for gold and silver. You see it here and there, particularly back in May in response to the drive-by shooting that we saw in April 12 through 15 with the initial 400-ton attack in the access market hours of sale orders that people have speculated were coming out of Merrill Lynch, but in service of the Federal Reserve most likely. But the point being that we have yet to even see a reignition of the North American buying market, and India certainly has had some restrictions for their purchases of gold after all of the efforts that they've been doing with rising import taxes, curtailment of the ability to purchase gold on credit, outright bans of the sale of investment-grade coins and whatnot from jewelry dealers, and on and on. Pakistan.
Just this week, I believe, they came out and actually banned the importation of coins, the gold coins.
Exactly. So, smuggling is filling a 20 to 40% hole that all of these restrictions are impacting in terms of the marketplace, and I'm doing some work on that, and hopefully by sometime next week I'll be able to put out an article for all of our readers and listeners that will actually attempt to document some of this stuff. As a side note, I've noticed that there's a rather strange presentation of the statistics coming out of the central bank in India where they're conflating both silver and gold imports in single numbers and attempting to claim that silver imports are in fact minuscule, which just is not believable at all. And then also, I believe it was back in May, they initially had reported an import figure of 200 and, this is off the top of my head, it was in excess of 250 metric tons of gold, but then immediately, about a half a day later, they said, whoops, we made a mistake. It's actually 100 metric tons less than that. There's obviously, above and beyond the direct management of imports and taxations and restrictions, and even getting neighboring countries to participate in terms of Pakistan doing a 30-day delay of imports. They're just outright lying. There's clear indication that they're freaking out and they don't know how to deal with this. And the strong seasonal buying period for India basically is beginning now. And all the while, China has been consistently buying and will, at the end of this year, easily be the largest gold purchaser in the open markets, above and beyond even their internal consumption of what their mining industry is putting out. Gold and silver demand is on the rise. Short folks in the financial institutions for hedge funds are pushed up against the wall. JP Morgan and their kind are presumably net long at this point based on all of the reports that we see. All of these things are aligning for much, much higher prices. When it comes to silver, we'll probably hit, say, 26 or so and see that as a period or a level that will be significant resistance. The cartel will use that as a point to try to keep the things under control to some extent.
I would definitely expect bounce off of somewhere around, and it might even be a little bit earlier than that, around 25.50 to the 26 level.
Exactly.
As you said, if that doesn't hold, the shorts are in big trouble, but I think we're likely to see a bounce back off of that, at least temporarily.
Yeah, temporarily, that would be the point to take home. I mean, it's not. This bull market is going to reinvigorate and rejuvenate itself to the shock and surprise of pretty much everybody, with the exception of those that are the most stalwart in terms of understanding the true fundamentals. I mean, the fundamentals have never changed. They've only grown stronger, and now with the interest rates backing up, the entire financial edifice of this paper Ponzi system that we've built is beginning to unravel. If interest rates move quickly, that will be very dangerous. I mean, the best hope for everybody out here, and Ben Bernanke as well, as he puts himself to bed this weekend and contemplates life, is that the 10-year, the 30-year, or so forth are going to be going up at a measured rate as opposed to spiking. Because God forbid, if things start spiking, there's just a derivative crisis in the making that could really make this ugly for everybody, even those that are most prepared financially. It's not something we should be rooting for, but unfortunately, the way the system has been set up with all of the abuses and corruption and indifference and the lack of long-term planning. I mean, in the United States, the economic policy mavens, think long-term is 6 months. You compare that to the way people in China think in terms of their management of their government, and the comparison is pretty stark and sad.
Yeah, if the rates start spiking, Bernanke might not make it till January.
Yeah.
Well, I wanted to get a quick update for our listeners. A lot of listeners give us feedback that they really like the updates on the wholesale market here in the U.S. It's been holding steady, really, for the official mint products like the Silver Eagle and the Silver Maples. Maples are pretty much live, available live throughout the U.S. wholesalers. Eagles, a slight delay, 1 week, 2 weeks, 3 weeks, pretty much across the board. Philharmonics are in stock at numerous suppliers live. It's more the generic products that are having issues. Several of our big suppliers for the 1 ounce rounds are running about 3 week delays. 90% silver remains just about unattainable, pretty much out of stock across the board. A couple places that have it. There are some delays, and enormously high premiums remain in the 90% compared to the last 5-10 years. And also the 100-ounce bars, the Johnson Matthey and the Engelhard bars, are pretty much out of stock and unavailable. The wholesalers aren't even giving delays. The Johnson Matthey and the Engelhard bars, there's only one U.S. supplier that'll even sell them to you right now, and they're quoting 2-month delays, so that's pretty unprecedented for a 100-ounce bar. But premiums are pretty much held steady for the week, although what we saw at SD Bullion after sales were down quite a bit last week with price around 19 and not too much excitement as buyers, and the more silver went up, the more our phones rang and the more orders were coming in. So hopefully some of our listeners bought over the weekend before the big rally began.
I know you were buying.
That's true, I was. Put in a pretty large order last Friday based on what I saw in the markets. And Eric and I both think looking at the chart here today, similar action to close the day on Friday. Don't be surprised if the shorts continue to freak out into especially the early part of next week. Still in freakout mode. It'll be pretty interesting how soon that target of the 25 to 26 level is reached. I don't think a week ago we would have expected it to be reached in a week and a half, but it's possible.
It could very well happen. And again, that is just an intermission in a longer-term bull market move, and it would be very logical for 25.50 to 26 be serving as a 2 to 5 day intermission. So folks, don't be surprised if you see that. Don't interpret that as being the end of everything in this bull market move, because the fundamentals, as we have said all along, never changed, and at this point they're actually beginning to get stronger. And the common notion of interest rates being bad for bullion is only relevant when you have truly positive interest rates competing with gold and silver to a lesser extent. That's nowhere near the case. We remain in an area where inflation, even as reported by the government numbers, being pretty much on par with the 10-year note. And then if you look at real-world inflation, not the smoke and mirrors that was coming out of Washington, we're probably on a U.S. basis somewhere in the neighborhood of 8 to 9%. And as Obamacare comes and other pressures from resources, and particularly with oil at 108 West Texas Intermediate crude as of today, those things are going to be moving through the economy and resulting in inflation coming out. The financial markets have actually been like a sponge, absorbing the excess liquidity that's been generated by the Fed. And this transmission mechanism is not necessarily an intuitive thing at first glance, but what happens is basically the Fed's been buying $85 billion worth of financial assets directly out of the Treasury, and in turn also buying the garbage that the banks have on their balance sheets when it comes to mortgage-backed securities. When that happens at a bank, the bank suddenly has more ability to go out and make investments, and they're not necessarily investing that much in the general economy in terms of making loans to people and businesses and whatnot. They're going out and speculating with financial assets. That's why we've seen a inflation in financial assets since, the better part of the last year or so, and all of that is beginning to reverse as well, too. So it fits with what's happening in the bond market and what we discussed earlier in the show, and all of these signs are pointing to the bullion market doing very well going forward. Right. It'll be a nice end of the year, and frankly, I think we even have the capability of seeing the old highs being taken out by the end of December, and certainly by March 1st, when the seasonal period of buying tends to be pretty strong in the first quarter of the typical year. When that happens, and as we're at this time 6 months forward talking about what's going on in the marketplace, people will probably be pretty bullish again in the bullion sector, and have already gone through that whole cycle of complete denial and shock, which is where we are now. Most people are not in bullion, and certainly in the West, to return of speculation and whatnot, and momentum players pushing higher prices, and believe it or not, silver even getting over $50 sometime early next year is doable.
Now, silver crossing 50 and gold crossing 2,000 is going to turn a lot of heads when it happens. There's going to be a lot of people chasing that. Kind of wrap things up here. We've got the market down for the week, the bond market rolling over with the 30-year already rolling over, the gold and silver shorts remaining in freak-out mode here on Friday. Silver continuing its rally, gold up another $20, silver up almost $4 in the week. So go enjoy your weekend, rent a movie, go do something outside with your family. You got about 48 hours before you can start refreshing the charts, so enjoy your time off. For the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.